Now assets can be classified into two parts, that is current asset and non-current asset. Now non-current assets, for example land, building, machinery, now it can also be classified into two further categories. First one is tangible asset and the second one is intangible asset. Now what does tangible and intangible means? Tangible is anything which can be seen and touched. For example, you can see the furniture, you can touch the furniture, you can see the machinery, you can touch the machinery. Now this all will be considered as the tangible asset. Anything that is having the physical existence. Physical existence means it can be seen and it can be touched. For example, furniture, goods, etc. Now what is intangible? Intangible is basically anything that have no physical existence. No physical existence means it cannot be seen, it cannot be touched. For example, goodwill or any computer software that has been made. Okay, so tangible and tangible are two categories of non-current asset. Tangible is basically having the physical existence which can be seen and touched, for example furniture, machinery, goods, etc. And intangible is basically which do not have any physical existence, which means that it cannot be seen or it cannot be touched. For example, the goodwill or the computer software. For example, you have made certain software, that software is into the computer only, you cannot see that software, you cannot touch that software. So this will be considered as the intangible asset for the firm. Now current asset, as already told, it is the goods for the resale or the debtors. Debtors is the amount you have given to certain other persons. Like creditors is you have taken the amount, and debtors is the you have given the amount to other persons. So asset is basically classified into two major categories, non-current asset and current assets. And non-current assets are further classified into tangible assets and intangible asset. Now there is one particular more asset category that is very much important to understand. It is fictitious assets. What are basically fictitious assets? Like we have already talked that asset can be of tangible or intangible nature. Now fictitious assets are those assets which are neither tangible nor intangible. For example, they are the losses written off in the future period but not in the period they incurred. What does this basically means? That fictitious assets are those assets which are not intangible, which are not tangible, but they are the losses that has already incurred by the firm and it is to be written off in the future. For example, you have losses of the year 2020, and that year 2020 at that can be written off in the period 2021 and or 2022, or it can be written off later on. So it is basically the losses that need to be written off in the future period but not in the period they have incurred. For example, they have incurred the losses in the year 2020, so these losses will not be written off in the year 2020. Now the next one is receipt. Receipt is basically any amount of money received or receivable from selling the goods or giving services. Like you are providing certain amount of certain services, or you are selling certain amount of goods into the market, so this will be considered as the receipt. Receipt is basically any amount that you have received against the goods sold or the services provided. For example, you are selling the goods, let's say for amount of rupees 50,000. Now here the amount received, that is amount of 50,000 received, will be considered as receipt for the firm. And what is expenditure? Expenditure is the amount spent or paid for acquiring the asset or the goods. It means any amount of money that is being spent by the business for purchasing certain asset or for the manufacturing of certain goods. it will be considered as expenditure. Now these receipts and expenditure are basically the two words that is being used for non-profitable organizations. What are non-profitable organizations? These are basically the organizations that are not run for the motive of profit. They are basically run for the providing services to the society. So receipt is the amount of money that is being received by the business. Expenditure is the any amount that is being paid by the business. Now expense, next one is expense. Expense is any cost incurred for generating the revenue. Any amount of money that is being spent by the business for getting the revenue for the firm is known as expense. For example, salaries paid, rent paid, insurance premium paid, etc. Now whenever you are running certain firm, so you need to appoint certain people, and if you appoint certain people, then you need to pay the same. So it is basically the expense. So it is basically the salaries paid to the people that are being hired. Now these salaries will be considered as expense for the firm, because you are spending that certain amount of money in order to generate the revenue, in order to generate the benefit for the firm. So expense is any cost incurred for generating the revenue. Examples are very much clear: salaries, rent, insurance. Okay. Next one is revenue. What basically revenue means? Revenue is the amount of money that you are receiving for the firm from selling the goods, or you can say that you render certain services, and because of that very services you received certain amount of commission, so that this will be considered as revenue. Any amount that you are receiving from selling the goods or providing services will be considered as revenue. For example, receipt of selling goods, rent received, commission received, etc. It is called as the revenue for the firm. Now these expenses and revenue are the words that are being used for profitable organizations. Profitable organizations are the organizations that are being run for the motive of profit. Here receipt and expenditure are the words used for non-profit organizations, and expense and revenue are the words that are being used for profitable organizations. And expense is the amount incurred for generating the revenue, and revenue is the amount that has been received against the amount of money spent. Next one is income or profit. Now whenever you are running a business for the purpose of earning profit, so how you can calculate profit is basically revenue minus expenditure. For example, you are spending, let's say 1 lakh rupees as an expense, and that expense might include the salaries paid, rent paid, commission paid, or insurance paid. So these all amount of expenses, let's say, is 1 lakh, and the amount of money that is being received against the expenses incurred is, let's say, 9 lakh. Now here 1 lakh is the amount of expense spent and 9 lakh is the amount of money that is being received. So what will be the profit? 9 lakh minus 1 lakh, that is 8 lakh is the amount of income or the profit that you have been received. Or in other way, I have written an example for you people for more clarity. Goods sold for rupees 20,000 and the same goods have the cost of rupees 15,000. Now you are selling the goods in the market for rupees 20,000. Now the certain amount of money has been spent for manufacturing the same goods. The cost here is for the same is 15,000. Now what will be the profit? Profit will be the 20,000, that is the amount of revenue you are receiving, minus 15,000, that is the amount of cost you are spending. So 5,000 is the amount of profit that you are receiving for the business, or you are making profit for the business. Now this profit can be classified into two categories, that is GP and NP. What GP is? Gross profit. GP is gross profit and NP is the net profit. What basically gross profit means? It is only the revenue from the sale of goods. When you are spending the money for basically selling the goods in the market, it is known as gross profit. Like you are just spending the money for the manufacturing of the goods, it will be considered as gross profit. Now it is the direct cost that is to be taken into the consideration. Direct cost is the cost, that is the amount of money being spent for manufacturing the business and selling the same in the market. For example, you are not spending the money for the rent purpose, you are not spending the money for the insurance purpose, but you are spending the money only for making the profit from the goods that you are manufacturing. It is called as gross profit. And what is net profit? Net profit is the profit which also considers the indirect cost. What is indirect cost? It is that cost which is other than the direct cost. Like I have said, rent is the expense, salary is the expense. So where this will be considered? It will be considered under the indirect cost. Now for calculating the profit from the goods, if the direct cost is considered, it will be called as GP, that is gross profit. And if you are considering the indirect cost also, then it will be called as net profit. So here gross profit only include the direct cost. It includes both direct and indirect cost. For example, you are taking into the consideration salaries, commission, etc. that is being spent for generating the profit. So what basically profit means? It is the revenue over the expenditure. Okay, so it is being classified into two parts, gross profit and net profit. I think it is very much clear what is the difference between gross profit and net profit. Gross profit only consider the direct cost. Direct cost is the cost that is related to only and only the manufacturing, and net profit is the cost that also take into the consideration the indirect cost, including those of direct cost also. Okay, and the next one is gain. Now we have certain assets which are of tangible nature. We have studied earlier that certain assets are the assets which are of tangible nature. So what basically gain means? It is non-recurrent nature of profit. Non-recurrent nature means anything you are selling into the market, tangible asset you are selling into the market, but you don't have the business of the same. For example, you are a manufacturer of fans. Now here, you being the manufacturer of the fans need furniture for your firm, need machinery for manufacturing the fans. Now machinery here get expired means it cannot be used for the longer period now. So you are selling the same machinery in the market. This will be considered as the gain from the non-recurrent nature. What is basically non-recurrent nature? This machinery will not be sold again and again in the market. It will be sold in the market once in a while. Once in a while means it is of non-recurrent nature. So any profit you are making by selling the machinery into the market, this will be considered as non-recurrent nature gain. For example, here sale of machinery, computer. Now machinery you sold in the market, let's say for 15,000, but machinery has a cost of rupees, let's say 10,000. So here gain will be 5,000 rupees. Okay, so gain is the amount of machinery, the cost of machinery, which is 10,000 over the current value of the machinery, which is 15,000. So here gain will be 5,000. So it should be of non-recurrent nature. What does non-recurrent nature means? That it is not being sold in the market repetitively. Once in a while it is being sold into the market. So here it means gains. Losses is when the expenses are more than your income from the non-recurrent activity. Now here, if we take the same example, what losses means? That if the cost of the machinery is 10,000, okay, 10,000, but you sold the machinery for only 5,000. So here 10,000 is the cost and 5,000 is the market value. So 5,000 will be considered as your losses. Okay. Another example has been given here. Machinery costing rupees 20,000 sold in the market for rupees 20,000. Machinery costing rupees 25,000 sold in the market for 20,000. Now 25,000 is the cost, actual cost, but market value is only 20,000. So 5,000 will be your loss. Okay, so gain or losses are the two words that are being used for the non-recurrent nature. If you are earning profit, then it will be gain from the non-recurrent nature. Okay, but if you are having losses from your non-recurrent nature, if you are do not having profits from the non-recurrent nature, then it will be considered as your losses. Next one here is purchases. What basically purchase means that any amount for taking the goods for the production in the future will be considered as purchases. Any amount that is being spent, like if you are a manufacturing firm or if you are a manufacturing unit, then you need to manufacture certain goods in the market. Now these amount spent in the market for manufacturing the goods, it will be considered as your purchases. Like for example, if you want to manufacture the fans, now you need to purchase the raw material for the making the fans. Okay, raw material can be the spare parts for the fan. So this for purchasing the same, you need to spend certain amount of money. So this will be considered as your purchases. Now purchases can be now further classified into two categories. It can be cash purchases or it can be credit purchases. Cash and credit terms has already been explained. Cash is being paid immediately, credit is it is to be paid later on. So purchases can be in the form of cash or it can be in the form of credit. Okay, now here the next term is purchase return. What is basically purchase return? When the goods received for the purpose of production are sent back to the owner because of any reason such as its defectiveness or etc. Like you purchased a certain amount of spare parts for your fan, making for the production of the fan. Now these spare parts are having certain defects because of which you cannot produce the fans properly. So these defective goods, when are sent back to the owner, it is known as your purchase return. Okay, next one is sales. Now when you have already manufactured the fans, you will be selling the same into the market for certain amount of money. Whenever you will be ready to sell the fans in the market or sell the same in the market, it will be considered as your sales. So when after production you sell the goods in the market, that amount of money received will be considered as your sales. Now sales can be further classified into cash sales or credit sales. Like you can receive the amount of money immediately or you will be receiving the amount of money later on. Next one is sales return. So sales return is whenever you have sold means business have sold certain amount of goods into the market, that goods are defective, and when you are receiving those goods back in the firm, it will be considered as your sales return. So any good sold in the market comes back to you because of its defectiveness or any other reason, it will be considered as your sales return. Okay, we have certain other terms. We'll discuss the same in other videos, in the next video, coming videos.